This is the second part, raising capital, in which we are talking about underwriter, as I mentioned. So underwriters, what are the job of service provided by the underwriters is formulate method used to issue securities, price the securities, and sell the securities, and price stabilization by lead underwriters. That's their job. Sometimes if the public offerings is for a big corporation and the amount involved for the sale is huge, in that case, there is a possibility that two or more uh, investment banks can make a syndicate, or they make a mm, group. We call them as a syndicate to write a contract with the public offering for the public offering. And that's what we call it as a group of underwriters that market the securities and share the risk associated with the selling the issue. Uh, So if there are two, three small underwriters, so they can combine together to underwrite a big corporation's IPO. So the main service they provide is formulate method to issue security. So they take these technical aspects of issuing securities. They also determine the price for the security because they have a good knowledge of the stock market in the market situation as well as the financial situation of the firms. They sell the securities to the public, and sometimes if they are also hired for that purposes, that they as a because they are the major player in the market. So what they do, they do some activities to stabilize the price of the new issue. They buy and sell in the market so that they can stabilize the price to avoid fluctuation in the market for that particular. Now, what the income or source of a profit for the underwriter is the difference between what the syndicate pays the company and what the security sells for in the market. So one, if they are firm commitment type of agreement with the firm to sell their securities, in that case, the difference of the price that the firm commitment price and the price they are offering to the public, the difference is their profit. And so, uh, firm commitment underwriting, as I mentioned, also called as a bought deal, means that the investment bank first purchased all the securities from the firm and then sell it to the public. That's what we call it as a bought deal, already purchased, and then they want to sell it. So we see here issue sells entire issue to the underwrite syndicate, and then the syndicate then sell the issues to the public, and this underwrite makes money on the spread between the price paid to the issuer and the price received from the investors when the stock is sold. So in this case, what is the risk? The syndicate bears the risk of not being able to sell the entire issue for more than the cost. That is a possibility that the risk is there that they are not able to sell it. So most common type of underwriting in Canada. So this is the most common form of underwriting, or not only in Canada, but all over the world, that they do this exercise before going to public for selling their securities. So this is the way that it works for firm commitment underwriting. But there's another we discuss in the part one as well, the best effort underwriting. In this case, as I mentioned earlier, it is just like a realtor. Like they put their effort and they try their best to get the maximum price for that. In that case, there is no underwriter must make their best effort to sell the securities at an agreed upon offering price, and the company bears the risk of issuing not being sold. The offer may be pulled if there is not enough interest at the offer price. So in this situation, the company does not get the capital and they have still incurred substantial floating cost because they have to pay the commission to the underwriter whether they are able to sell it or not. So it means what we want to make it here is that In firm commitment, the risk is transferred to the underwriter, but in best effort underwriting, the risk is with the firm, not going to the underwriter. And definitely, the profit margin for underwriter is going to be go down in case of a best efforts. The third one is a Dutch auction underwriting, in which the underwriter do auctioning, like, and try to get the price at the moment, or who is offering the best price. Underwriter conduct an auction and investor bids for shares. Offer price is determined based on the submitted bids. Most commonly used in the bond market, this type of Dutch auctioning bond market, everyone is submitting their bids. The which one is the highest bidder will get the shares on. Also called as a uniform price auctioning. So that is also called a, so the highest bidder, the bidder is going to get it. Over allotment option is also sometimes given to the underwriter, like over allotment or a green shoe provision allows syndicate to purchase an additional 15% of the issue from the issuer, allows the issue to be oversubscribed, provide some protection for the lead underwriter as they perform their price stabilization function. Uh, Now, additional details regarding this underwriting business is that lockup agreement specify how long insiders must wait for after an IPO before they can sell stocks, usually 180 days. Like if they are buying, like the underwriter is buying because he is considered to be insider. He has a complete information about the firm, so if they are buying, they are not allowed to do sell, or the selling of those stocks before 180 days. Quiet period in which the underwriter is not saying any single word regarding the IPO, except the ordinary announcements. For 40 days following an IPO, the OSC requires that all communication with the public are limited to ordinary investors. So it's a quiet period. We call them as a quiet period when you issue an IPO, that there is no need to announce anything, because there is a way to fluctuate the prices by good news is or bad news is. So by this way, there is a restriction there. IPO underpricing, initial public offering may be difficult to price an IPO because there is not a current market price available. So they have to figure it out a price which is acceptable in the market. So additional asymmetric information associated with the companies going public. Underwriters want to ensure that their clients earn a good return on IPO on average, and underpricing cause the issuer to leave money on the table. Now, these are the data available. This data is available for Canadian US public offerings between 1960 to 2013. It's um, a long-term data or long data for a longer time period. And it's about 53 years data about for 53 years. And we see that how the price is going to go up and down uh, after average first day returns. Means that when the IPO is launched and it starts trading on the stock market, what happens to the price of the stocks? It go up or down. So first day returns. And this is a presentation of a graphic. So we see that in some time periods, there is a very high uh, increase in the first day. Uh, Average initial returns for SEC registered IPOs between 1960 to 2014. So we see that in most of the cases over this long period of time of 54, 53 years, uh, the IPOs getting high returns, except very few occasions like here, this case and this one and this one. Uh, in most of the cases, the investor is getting benefit by returns. First day average returns is very high. This is also the number of offerings for SEC registered IPOs, and IPOs are enormous during this period. If you look at this period, and this period is a real corporate sector growth period in US. New equity issue and price. So stock prices tend to decline when new equity is issued. Possible explanation for this phenomena is managerial information and signaling, uh, debt usage and signaling, and issue costs. So these are the possible explanations for the phenomena that explains that why the new issues price decline in a uh, first day or in a very few initial period of the issuing. Since the drop in price can be significant and much of the drop may be attributable to negative signaling, it is important for management to understand the signal that are being sent and try to reduce the effect when possible. So most of the time when the prices go down, it is because of the wrong signaling uh, omitted or emitted by the manager. So if they uh, give a negative signal regarding the borrowing or debt usage or issue cost, if and that's the reason that there is a quiet period that no information is going to go out to affect the price. Uh, So the cost of issuing securities. Sorry, yes, I think it's going to be added up in the third part. So this is our second part of the chapter regarding raising capital.